Welcome to the Jay Martin Show. My name is Jay Martin, and my guest today is Lyn Alden of Lyn Alden Investment Strategy. One of my favorite guests, definitely a crowd favorite, and today's discussion was fascinating. We really focused on the debt ceiling, but from the standpoint of the impact on the treasury market as the underlying foundation of our financial system, and on liquidity, which is the oxygen of our economies. So very interesting discussion today. I learned a ton, as I always do when I chat with Lyn. We also touched on the trend of de-dollarization. We got into the commodities market, the Bitcoin market, and many, many other things. In addition to Lyn's new book called Broken Money, which is coming out very soon, and I'm very excited about that. As always, if you enjoy my content, I publish a weekly newsletter. It comes out every Sunday. I absolutely love writing it. I focus on the psychology of decision making for investors. I manage an investment portfolio, but I don't write about managing money. I write about managing my mind, which is the most important tool in any investor's tool belt. So hit that link below this piece of content if you would like to hear from me every Sunday. Here is Lyn Alden. Enjoy.
This is Jay Martin.
All right, here I am with Lyn Alden. Lyn, it's great to have you back on the show. Thanks so much for making the time.
Happy to be here. Always happy to come on.
Okay, so I wanted to focus today's discussion largely on the debt ceiling and this, we could speculate on the aftermath. And the reason I want to do that is because if you were to ask me a month ago, what's the consequence of us reaching another debt ceiling? I was responding, nothing, right? This is an inconsequential non-event because we've done this 78 times in the past. And every single time we do what anybody does when they can't pay their debts. They amend, extend, and pretend, right? You amend the terms to extend the credit and pretend that everything is just fine. And maybe everything is just fine, or maybe it isn't, but that's what I want to talk with you about today. And honestly, I want to start with the most basic question, Lyn. What is the debt ceiling, and why do we have it?
Sure, it's a good question. So back a little over 100 years ago, going into like World War One, when they issued bonds to fund the government, if they were, for a period of time, if they were running a deficit and they had to have, either rolling existing debt or issuing, new debt to fund deficits, Congress would basically say, okay, we're going to do this bond auction for this purpose. And so they had kind of a specific overview of what the issuance was actually doing. But eventually, especially in World War One and in the aftermath, as the federal government got larger, the administrative burden, like a burden of trying to like micromanage the types of debt issuance for Congress was unworkable. And so instead, they said, okay, the Treasury Department is going to deal with those details. They can handle what duration of bond they want to issue. They can figure out, all the nuances of how they want to manage the debt, with the caveat that Congress is still going to gain control by saying you can limit issue debt up to this amount. So it's basically gaining control, like maintaining control, but no longer micromanaging. And so that's basically the process we've had for about a century. And over those 70 plus times of raising the debt ceiling, I mean, most of those are non-controversial because that wasn't really like the tool that was used for budget stuff, because it's not what determined. It's not like the debt ceiling debate is setting the budget. They in different bills, they set the budget. They determine what we're going to spend money on, what we're going to do. And so this is kind of like a separate thing. But in recent years, especially over the past decade and a half, it's become a tool that a party can use as like a negotiating chip. Say, okay, well, here we have this like, thing that kind of requires both of our support. And so the political parties can see if they can gain any sort of leverage from this event. And so really this is now certainly in the top two or top three debt ceiling disputes. So the long tail of most of them aren't really dramatic. The one in, I believe, 2011 was pretty dramatic. We've had maybe two or three pretty serious ones, and this is now among them. And so the issue is that if that were to be hit, you either risk potentially default on the treasuries, not because they can always print the money, but they have these, again, self-imposed kind of restrictions on how they're going to break down control of it, or they have to start missing some key payments like Social Security payments or military salaries, things like that, because most of the federal budget is not, we think of like the federal government, we think of all the different functions they do, but that's actually a tiny part of the pie chart of government expenditure. The vast majority of government expenditure falls into the buckets of Social Security, Medicare, and military and military adjacent things like veterans benefits, homeland security, that kind of stuff. So that's where the vast majority of spending is. And so when you have that debt ceiling, you either start defaulting or you start having to cut spending. And we've been in this period since January where they technically ran into the debt ceiling limit, meaning they couldn't issue net new debt, but then they still had a number of levers that they could pull in order to not actually run into those more severe consequences. Um, the biggest one that they can do is that the Treasury has a cash balance that they hold at the Fed. The Fed is, like their checking account. They hold their cash balance at the Fed, and so they always have some amount of working capital. Currently, they target to have around $500 billion. So they have this like if you were to say lose your job, like lose your income sources, and you can't issue any more debt, what you'd have to do to maintain your expenses, you'd have to start drawing down on your savings. And so essentially that's what they've been doing since January. And now we're getting to the point where they're almost out of their cash balance. And they've already used some of the other levers that they can pull. And so now they actually start to hit the crunch time for either it's going to be extended or certain payments are going to be missed.
Okay. Okay. So to quickly recap, Congress used to micromanage by approving every expense, essentially, I'm going to write a check. I need you to authorize it. That became too much to manage. And so we moved to almost more of like a credit card example. Here's your card. You can spend up to X dollars. We don't care what you spend it on. But once you hit that limit, we have to talk. All right.
Actually, so it's a little different. They still all the expenses are still authorized by Congress. So all those spending authorizations. What they used to micromanage was the types of debt structures that they would use to fund those expenditures, or at least the portion that doesn't come from taxes. So they micromanage both the spending and how to pay for that spending. And now they still, it's not like they can just authorize. It's not like the Treasury's just given a budget and allowed to spend it. All these authorizations are still done by Congress. But what they gave control to the Treasury for, which is how the Treasury wants to issue debt to cover the expenses that Congress has already authorized. So they have Social Security laws, they have military budgets, they have Medicare, they have these other operational budgets, and it's up to the Treasury to manage the incoming tax revenue and the expenditures, and then any kind of leftover, they determine how much debt they have to issue on a given time frame and what kind of instruments they want to use. Long duration, short duration, tips, how they want to time the auctions, all those details are left up to the Treasury.
Right. Okay. So yes, and that is the distinction you mentioned earlier. The debt ceiling discussion is not a budget discussion. Those are very separate things. Thank you for clarifying that. Okay. So once we've exercised the tools we have access to, we've drawn down the Treasury general account. Maybe it was about $500 billion. It's significantly less than that now because we've been drawing down on that since January. There's some other tools like they can stop reinvesting civilian and soldier retirement holdings. I'm not quite clear on how that functions, but maybe you could spend a second just chatting on that. Eventually, though, we get to the point where we have to extend or default. And both of those things could happen in theory, right? We could have a short-term temporary default before an extension. Is that correct?
Yes. And so, when we talk about defaults, there's obviously different types of defaults. So one kind of default is like, if an emerging market has dollar debt and they just literally run out of dollars and can't pay, that's an actual default and restructuring.
Okay.
Whereas, this is more of a self-imposed default. And so they can either have a technical default, which they had once in the past. There was like a technical issue they had decades ago where they actually had a very brief temporary default. Um, or you could have a more permanent default. So obviously the base case here is either last minute deal or a temporary technical default. And the timing is a little bit bimodal because there's obviously quarterly tax payments that a number of large entities do. So most people think of their tax payments as once a year, as well as through every paycheck, but businesses often pay quarterly. And so there's a lot of tax payments that are due in the middle of June. And so if they were to run out of cash before then, they could default as early as early June. Should they make it to mid-June, then there's a good chance they make it to early July because then they have that like kind of like temporary, multi-week reprieve. And so that's why the estimates for when they run out can range widely, it's because of the timing of that quarterly payment as well as the unknown magnitude of what that quarterly payment will be exactly.
And what do you watch to determine the market's confidence in an agreement being reached? And in your April newsletter, you referenced the 1 month versus the 3 month treasury yield as an indicator of market confidence in a debt ceiling agreement being reached. Can you touch on that for a second?
Yeah, so one you can look at is credit default swaps. A really easy one to watch is that difference between, say, 1 year, 1 month, and 3 month treasuries. Now that we're having the discussion later, that's kind of no longer a useful signal because now even the 1 month treasury is in the line of fire for potential default.
Okay.
Whereas before, in April, when I discussed that, it was kind of an interesting market signal because they were willing to aggressively bid for 1 month treasuries because they're almost certain that these are going to mature before the deadline. And so these have virtually zero chance of default. Whereas the 3 month and later treasuries were now kind of like firmly in line where like these are going to mature after a potential deadline. And so there's a premium for getting the 1 month treasuries. And again, even the holders of those long duration treasuries are still kind of assuming that even if there's a technical default, they will be made whole some days or weeks later as that's reconciled. But especially for financial functions, one is there's like administrative costs of dealing with that, and two, some of them are held on leverage, or some of them have um, claims that can be pulled out. Like if you're a fund managing money, and you have investors that can pull money out, and you hold treasuries, and some of those treasuries are defaulted on, unless you're going to get paid back in 2 weeks, and your clients want money now, well, that's a problem. If you're using treasuries as collateral for loans, and those treasuries just became defaulted on. Even if on one hand you can be like, look, give me 2 weeks. I mean, they're going to sort this out. That's still a problem that entities would rather avoid if they could. And so there was that temporary premium on 1 month T-bills just to avoid that headache for that particular cycle. Um, and so the market is taking this one somewhat seriously. It's not considering it the base case of a technical default, but it's not completely brushing it off either.
Okay. And so with that, you're looking at the maturation date of those treasuries 1 month. They're going to be in the money. We feel pretty confident about that. But 3 month, we're in a vulnerable part of the calendar. Far less confidence in that.
Yes, and that's how it was back in April, whereas now the whole spectrum's in the line of fire. It's all, yeah.
Okay. Okay. I want to segue into implications on liquidity. And maybe let's start with the last period leading up to this debt ceiling, different actions the Fed has taken that have had negative or positive impacts on liquidity, and what you might expect to occur during and after this process.
Yeah, it's a good question because I think that there's so much media attention on the debt ceiling itself and the possibility of default, which is, of course, it's a newsworthy event. It's also it's really good for clicks and things like that.
Right.
The from a macro perspective, um, beyond whatever, last minute deal or technical default or whatever they do, for me, the question is once they get it resolved, what is the next steps for liquidity? So to answer your other question, if you go back, ever since early 2022, the Federal Reserve has been doing quantitative tightening, where they're reducing their balance sheet, and then they're also separately raising rates. And so they're trying to tighten monetary conditions. If we look at the quantitative tightening, what that means is that they let some of their existing bonds mature, and then rather than reinvest those as they would, they just don't reinvest those, which means that as the Treasury needs to reissue them, some other buyer has to come in and buy them. And so the Federal Reserve is basically slowly destroying base money, and reducing their holdings of mortgage-backed securities and treasuries, which means those securities have to be absorbed by other participants in the market. It's very similar to if they were to sell them, with some minor technical differences because they don't realize like a loss or anything like that. They just let them mature. Um, and that's been a liquidity drain, and liquidity drains are very correlated with kind of negative asset pricing. It's not great for markets. QE is kind of like inflation for financial assets. Um, and but that's been somewhat offset over the past 6+ months by the Treasury. So, the market did very, very poorly, especially in the first half of 2022, and extending into kind of the autumn of 2022, the market did very poorly. That's when you had just the Federal Reserve is drawing down the liquidity. And while they continued doing that since then, the Treasury started offsetting them starting around autumn of 2022, especially. And so the Treasury, like I mentioned, has this cash balance. And theirs was above target. They had more cash than usual in their Treasury General account. And we could think of that as almost like a void. They previously issued more bonds than they spent. And so they pulled in capital. They pulled in capital from the banking system and elsewhere. And they're storing it in this void that's not really being used for anything. So it actually kind of pulls liquidity out of the market while they grow that cash balance.
Okay.
Um, Now, when they start reducing that cash balance, they're starting to spend it back into the market. They're basically pulling it out of this like liquidity void and putting it back into, circulating liquidity. And so as they draw down their cash balance, it's pro liquidity. And so for ever since autumn of 2022, they've been roughly offsetting the Federal Reserve's quantitative tightening. They've been putting liquidity into the market about as quickly as the Fed's been removing liquidity from the market. Um, and so liquidity was going down for the first, say, 3 quarters of 2022. But ever since then, liquidity's been going sideways. And if you look at the reason that's relevant, and this sounds very jargony, but the reason it's relevant is because the dollar index peaked in autumn of 2022, right
Okay.
when liquidity indicators started going from down to sideways.
Yes.
Um, the S&P 500 bottomed right at the same time. The treasury market in that autumn period was getting very illiquid. You were starting to have like bad tailing auctions. The move index was like at like record highs. It was a really kind of messy treasury environment. And that's also when the UK gilt market broke. It just outright broke, and the Bank of England had to come in and do like emergency QE to save the UK pension system and prevent like this like spiral, this like liquidity spiral. And so that like transition to a flat liquidity environment was relevant for a broad swath of assets. Um, and the challenge going forward is that once the debt ceiling is resolved, because now that cash drain from the treasury is pretty much done. They pretty much, they spent the last 6 plus, maybe 9 months offsetting the Federal Reserve, and now they can't do that anymore. And worse than that, if the debt ceiling is resolved and they're able to issue a lot more debt, their target long term is to get the Treasury cash account back up to half a trillion. So, $500 billion roughly that they want to increase. So they want to suck liquidity back out of the market, while the Federal Reserve is still sucking liquidity out of the market. And so we risk going from a sideways liquidity environment to a deeply negative liquidity environment unless one of these entities blinks and changes course.
I publish a weekly newsletter every Sunday. If you would like to subscribe, hit the link right beneath this video. Now, I'm an investor, but I don't write about managing money. I write about managing my mind. Without question, the hardest and most important part of allocating capital through volatility and getting some back. If you want to read my newsletter, hit the link right beneath this video. I know you'll love it. Now back to the interview. Enjoy. So his recent history, we've seen both quantitative tightening, which decreases liquidity, and a drawdown of the half a trillion plus from the Treasury General account increase liquidity, creating this flat liquidity environment. But just the same as drawing down that Treasury General account increases liquidity, rebuilding it is going to decrease liquidity. And now we have both these forces working together. What's the consequence of you could say decreases in liquidity tend to harm asset prices, tend to drop GDP a little bit, both of which produce lower tax receipts, therefore increasing the federal deficit. So what's the puzzle they have to solve here? Because if they need to rebuild the general account, if they need to maintain QT in order to save face and credibility and whatnot, but this will amplify the deficit, will it not? Because both of those things contribute to lower tax receipts, which they need.
Yeah, it's a pretty difficult puzzle for them to solve. And so, as you pointed out, one is that because the U.S. economy is so financialized, tax revenue is highly correlated with asset prices. And I think one analyst that covered this particularly well was Luke Groman. He pointed out in the 90s there was various tax reform that changes the incentive structure for executive compensation to be more stock oriented. That was a big driving factor here. Just also in general, when you have very high debt and very high equity valuations, that also becomes very relevant. So basically, if we try to tighten monetary policy, if we try to get back to positive real yields, if we try to do QT and things like that, we start to get sideways or down, equity indices, real estate markets, things like that. And then deficits completely blow out because, expenditures are still there and now tax receipts have gone down. And we've seen that play out you know, in this year, the past, say 6+ months, deficits have been much larger than a similar 6-month period from a year ago. And so we've already seen this kind of deficit blowout. And the question becomes, if the Fed's not buying, foreigners are not really buying much either on net. Banks, obviously, they have all sorts of liquidity problems now, so they're not buying on net. And so the question becomes, who buys? And right now, the answer is retail investors, mutual funds, pensions, money managers, kind of like these non-bank domestic buyers, which have a limited balance sheet capacity. And so if the Treasury, if the liquidity starts going down again rather than sideways, if they have to issue, let's say, $1 trillion of Treasuries over a 6-month period, um, it's a question was, well, where do you get the dollars? Where are you going to suck out dollars to buy those? Um, and there's not that many pools of capital that can absorb that much. We can't really see more reserves come out of the banking system because that's already kind of tight liquidity wise. It's hard to get, say, bank reserves much below 3 trillion in the current, liquidity and regulatory environment. Um, One of the big pools of remaining liquidity is the reverse repo facility. And so that one has over $2 trillion worth of liquidity kind of locked inside of it. And really the only way to probably get that out is to issue a ton of T-bills, right? So again, the Treasury can determine what duration of issuance they want to have. And they have all sorts of considerations there. Whatever's kind of the cheapest part of the curve to issue debt on. They also want certain types of durations to be kind of a regular cadence. So they don't want to like rapidly change the average issuance of government debt and the timing of auctions. But basically, right now you have an inverted yield curve. So the T-bills are the most expensive way to finance the debt. The long duration is actually the cheapest way. The problem is that in order to get money out of the reverse repos, the Treasury would probably have to issue a ton of T-bills. So they'd have to issue a ton of debt at the most expensive part of the yield curve, which would be the best for liquidity, but the worst for, say, government interest expense. And they could issue up to, say, $2 trillion worth of just T-bills and probably suck that out of reverse repos without breaking stuff, at least in the near term. On the other hand, if they try to issue more coupons, that's not going to come out of reverse repos, and so that probably strains banking sector liquidity all over again, and you probably start to get messy auctions, illiquid treasury markets, and problems like that. Um, on the other hand, the Federal Reserve could blink, and they could say, okay, we have to stop doing quantitative tightening. Maybe they even have to do some new facility or quantitative easing, which if inflation's still above target, or if you get a second wave of inflation, could be obviously bad for credibility. They would essentially become kind of like what the Bank of England had to do last year, or what the Bank of Japan's been doing. They would enter that kind of sort of deficit monetization game, even if inflation's above target, which is not a good look.
Okay. Okay. So if the banking system can't buy more long duration bonds because their balance sheets aren't healthy enough, foreign buyers have not been buying long duration bonds, so that's probably not an option. We could look at issuing an extensive amount of T-bills and suck the money out of the reverse repo market. Are there implications of sucking $1 trillion, $2 trillion out of the reverse repo market? Is there a downside to that scenario? And what happens to reverse repos if all the cash is sucked into T-bills? Is there an effect there?
So the amount of reverse repos is still at near record levels, and it's kind of unnatural. Like that's basically capital that there's actually what that kind of is like excess demand for T-bills compared to how many T-bills there are.
Okay.
And it's funny because back in 2019 there was the opposite problem. During the repo spike, there was too many T-bills relative to basically cash on hand to buy T-bills. Now you have an opposite problem where you have tons of people that want to buy T-bills and there's just not enough T-bills. Um, and so that reverse repo is kind of like this big queue of entities that would want to buy T-bills. So a lot of it's money markets, people that say they want 3, 4, 5% yielding assets, short duration cash equivalents that don't have like bank default risk. And so that's kind of a big pool of capital that would like to own T-bills. Um, and so there's really not that many ramifications, I think, from issuing a ton of T-bills and pulling liquidity out of there. Is one of the levers that the treasury market has. The the implications that are there are one, that it's the most expensive part of the curve. So, it's like if you were to choose between, say, having a short duration mortgage at 5% or a long duration mortgage at 3%, right? You probably want the 3%, but this is like picking the 5% instead, right?
Yeah.
So that it's the treasury market saying, okay, we're going to finance ourselves with the most expensive part of the curve, and therefore that'll increase deficits because you're paying even more interest now.
Yeah.
So that's one implication. And the second implication is just that it'd be very unusual activity from the treasury to like rapidly adjust their average duration. They had to shorten their duration a little bit during the COVID crash of 2020 when you had kind of weird things going on. But generally, they like to keep bond auction cadence kind of, steady. They don't
Okay.
really plan on changing their average duration. And so it would be kind of like a Treasury QE type of thing. And they've already actually announced buybacks, treasury buybacks, which is they're willing to buy back off the run securities and issue on the run securities. So basically, the treasury market acknowledges that the treasury securities market is very kind of liquid and not in great working condition. And so they can do various things to try to augment that and make it liquid as possible. Even to some extent, the Federal Reserve's BTFP program that kind of helped some banks out, that also indirectly helps provide liquidity to the Treasury mortgage-backed security market. And so there's a bunch of different facilities that are kind of either lined up or already in place to kind of keep the Treasury market from having severe liquidity problems.
Okay. And you know what? Just for clarity's sake, could you could you explain as simply as is possible, in what is the reverse repo market? Just to add clarity there, I realize we just spent 7 minutes walking through that, and maybe just a simple explanation will be valuable to the viewers. So, what is, as simply as you can put it, what is the reverse repo market?
Right. So we can start with a repo. So repo is when basically you can post collateral, like say T-bills, and get dollars. And so that was used, for example, during the repo spike of 2019. A reverse repo is the opposite of that, where you can post dollars and get, say, T-bills. Um, and so basically it's like there's excess demand for dollars. And there's plenty, so and well, there's excess demand for T-bills, and there's plenty of dollars that can like go into that facility. And
Right.
so that's why if they were to issue a bunch of T-bills, for example, money markets could hold T-bills instead of having reverse repos, which is kind of like an indirect way of getting T-bill like exposure. Um, and so it's basically what repo and reverse repos facilities do from the Fed. What they share in common is that they try to increase fungibility between dollars and T-bills or other types of treasuries. Um, and so, some of the big problems they run into is if they issue a ton of treasuries and there's like liquidity issues and there's not enough dollars to buy those treasuries, it can cause problems. On the other hand, sometimes you have all this demand for collateral for treasuries and you have excess dollars. And so what these facilities do is try to make dollars and treasuries kind of more interchangeable.
Got it. Okay. All right. Now, if what other options does the Fed have here? Could they elect to just not replenish the Treasury general account yet? Like, could they keep that balance low? And what vulnerabilities arise if they just choose, look, the only way we can raise cash right now is through super expensive debt via T-bills. We don't want to do that. We can't afford those interest payments. How about we just don't replenish the general account? What happens there? And would they consider that?
So the Secretary Yellen could decide to do that. It'd be the Treasury's decision. Now they've already every quarter they give their targets for where they expect their Treasury General account to be. But kind of like the Fed, they often don't hit their own targets, right? So the Federal Reserve will say we're not even thinking about raising rates, and then they raise rates by record speed. Sometimes they say we're gonna pause, and then they end up cutting. The Treasury General account's kind of the same way, where they give targets on what they're going to do, but that's not super reliable for what they end up doing. But yes, so one of the things the Treasury could do is slow down or just pause their rate of refilling their cash account back up to their targets. And they could
Okay.
just operate at this low cash method. Um, that would probably delay or reduce the severity of some of these potential liquidity problems. But you still have the problem where you almost go back to like the first half of 2022, where the Federal Reserve was doing quantitative tightening and the Treasury was not offsetting it. So you had this like, big decline in liquidity. If you go to an environment where the Treasury just holds its cash flat rather than decreasing it or increasing it, and the Federal Reserve still doing quantitative tightening, you'd actually still go back to a period of negative liquidity, um, because you no longer have that offset.
Yeah.
So the treasury can kind of choose to be neutral or negative for liquidity here, based on either holding the cash account flat or increasing it. And the only kind of pro liquidity thing that they can do is shorten their treasury duration average and try to suck money out of reverse repos, but that would be considered an unusual activity.
Okay. Could there be a strategy where they try to decrease the value of the dollar, making bond issuance more attractive to foreign buyers? And would that make sense? Is that a direction they could consider?
They could, yes. And so could the Fed. I mean, if they want to have a weaker dollar. So generally, and to back up for the audience, we often think of that maybe foreign treasury demand and dollars indexes are correlated, but they're actually inversely correlated, which is what you're getting at there. So basically, when the dollar is weaker, there's more foreign demand for treasuries historically. When the dollar is having one of those like big bull runs, usually you see either flat or reduced foreign demand for treasuries. And that's often out of necessities because when the dollar is getting very strong, foreign central banks are basically defending their currency. So they're saying, okay, we're gonna hold our reserves flat, or even we're gonna sell reserves, sell treasuries, to kind of get dollars and maybe backstop our own currencies. Maybe we'll buy back some of our own currency, or because we have a dollar shortage and we need to lend dollars to our own bank, so we'll sell some of our treasuries to get dollars. Um, and so, what if they do want to entice more foreign demand? They can, moderately weaken the dollar, but that also could have inflation implications. I mean, if they're trying to fight inflation, um, and they drop the dollar index by 20% or 10% or whatever, that will probably translate into higher dollar-denominated oil prices, and just generally other higher kind of import prices. But it is one of the tools that they have, certainly, and that's kind of the reprieve we saw starting in the autumn of 2022. The Treasury's big, TGA decline was, kind of temporarily negative for the dollar because it was pro liquidity. And there's also, just probably other deals with central banks to kind of, work things out and kind of, maybe weaken the dollar around the margins. And so that's always a lever that they have available.
Now, when we reflect back on the last 30 minutes of our conversation, it strikes me how complex and challenging this situation is to manage. And frankly, what a mess it is. I mean, imagine if, any of our personal balance sheets look like this. You know, um, how much of that picture do you think, if any, is inspiring the trend that we call, Luke Romans touched on the trend of de-dollarization through BRICS economies and now expanding beyond that? Is there a lack of confidence that is rapidly accelerating in US and non-US friendly countries that is inspiring them to search for non-US dollar options with which they can conduct business and hold their savings essentially?
Yeah, I think we could divide, like, put, say, de-dollarization, or at least, we don't see like rapid de-dollarization, but we kind of see like no longer increasing dollarization over the
Yeah.
past
Okay.
number of years. And then,
Yeah.
this past year, you've seen a little bit more acceleration in de-dollarization. Um, and I think there's kind of two big underlying foundations for that. So number one is that ever since the global financial crisis, and a few years after that, um, a number of countries decided that basically treasuries are probably not going to be very attractive, and they don't want to finance the U.S. government at negative real yields. So I mean, for much of the 2010s decade, for example, T-bills were yielding less than inflation.
Yeah.
Longer duration treasuries were yielding, roughly in line with CPI. It kind of varied over time, and they were underperforming, other assets like equities and real estate and things like that. And so a lot of these governments said we don't really want to, facilitate that. China, in particular, in 2013, said it's no longer in our interest to keep accumulating treasuries. They just made to come out with a statement. And so what China was at the time in the prior decade, the biggest, net buyer of treasuries. And so what China started to do instead, for example, is they started to use their dollar surpluses, their dollar trade surpluses, instead of funneling them back into the US Treasury market, they started making loans, say that, the Belt and Road Initiative. They started doing kind of like what the IMF and World Bank do, on their own scale, where they go to countries in Africa or other countries in Asia or certain countries in Latin America or Eastern Europe, and they say, okay, we're going to provide dollar loans in order to build this, railway or this commodity development or this refinery. And so they found that to be a better use of their dollars than plowing them back into treasuries. You had other central banks, like say, the Swiss National Bank, plow it into U.S. equities. Um, rather than U.S. Treasuries. And the other ones, just, the dollar was pretty strong, especially, starting in 2014, 2015. And so many countries were just kind of not accumulating reserves and therefore just not accumulating much treasuries in general. You also saw from the 1970s until around 2009, there was this like net reduction in central banks holding of gold. Kind of it was like the slowly declining gold stash. But starting in 2009, you had like a V-shaped recovery where central banks began reaccumulating gold on net. And so they found that, to potentially be a better reserve asset for them. So that's number one is basically the unattractiveness of treasuries that don't keep up with inflation, which is an environment we've been in. The other one is basically that the treasury and the dollar market in general is a permissioned ledger. So it's a ledger that, you can be cut off from. Your assets can be unilaterally seized. And, obviously it's not done arbitrarily, but, most countries around the world have had periods of time over the past, say, 50 years where they've not been in the good graces of Washington for one way or another. The severity can obviously differ. Sometimes it's like an outright war. Other times it's just, various agreements. Maybe the Treasury doesn't want India doing business with Russia, and India says, well, we're going to do business with Russia. And so India is not in the bad graces of Washington, but it's not maybe not the best graces of Washington. So basically, a lot of countries are saying maybe we shouldn't have 100% of our reserves. Maybe we shouldn't have 80% of our reserves in dollars and treasuries because a handful of people in DC can just snap their fingers and seize those funds, or prevent us from accessing that whole ledger and making payments in dollars. And so there's a push by some countries to diversify their reserves. So either a couple different types of fiat currencies, or gold, for example, um, and then also to diversify their payment systems. So instead of being so reliant on Swift and having so many payments basically go through New York, they want to have, bridges between central banks and things like that in order to facilitate more non-dollar trade so that they can have their payment systems shut off either. So both has protection for their savings and payments, on a permission ledger. They want to have basically an assortment of other payment and savings mechanisms to choose from.
And does one kind of require the other? So you talked about alternative payment systems like bridges between two central banks that no longer include New York. They no longer include the SWIFT system. And the more bridges like that are built, um, it would therefore become easier for foreign nations to diversify their reserves because if the US dollar is not the absolute monopoly as a trade currency, then it doesn't have to be the first choice for a reserve currency, correct? Like if there's more options to trade, then you feel a bit more freedom with your reserves. Is that related? What do you think?
Yeah, I think they'd have more freedom with their reserves. They also might be able to hold less reserves because, like, nobody exactly, for example, wants to hold a lot of Chinese bonds. They don't want to have like, 50% of their central bank reserves in Chinese assets. Got capital controls. It's not super attractive. But China, for example, is the largest trading partner with most countries in the world now. Over the past 20 years, they've surpassed the US for most countries as their biggest trading partner. And so, with let's say China and Brazil trade, Brazil sends a lot of commodities to China, and China sends a lot of electronics and other products to Brazil. And so one thing they can do is just basically, like one of them gets a temporary surplus and then it gets plowed back into the goods of the other one. You have that more circular payment system that doesn't really need to use the dollar. And they both might hold some degree of each other's reserves, with excess reserves maybe going over into gold, or something like that. That's generally kind of a trend we're seeing. And so, while I don't think you'll see massive reserves, in these other types of countries, I think we're slowly seeing a diversification of reserves. I mean, Chinese holdings of Chinese assets among global central banks over the past, say, 5 years went from like virtually zero up to, you started to see countries doing like, 3, 4, 5% of their reserves in that. So it's a marginal change, which then we also combine with, gold increases. You have a little bit less focus on American and European assets as reserves, and a little bit more focus on bricks, gold, that kind of thing.
Okay. And so with in relation to the trend of central bankers accumulating gold, you pointed out that gold holdings hit absolute lows between 1970 and 2009 and then started trending upwards again. So could you make the claim it's more of a gold story as well? Like, yes, some countries are diversifying away from US dollars, or it's actually a reversion to the mean in terms of gold holdings for central banks.
Yeah, I view it like that. I mean, people in the past, when they talk about prior global reserve currencies, they act as though like there's just kind of like, a different reserve currency over time, which is partially true, but all those past ones were basically just proxies for gold. I mean,
Right.
central banks would hold gold. Sometimes they'd accept each other's, payment ledgers and bonds and things like that as like gold proxies that are maybe more convenient and pay some interest. But essentially gold was at the center of the system. And since the 1970s, the Treasury kind of replaced gold as a key part of the system, which is that, instead of holding a gold proxy, all these central banks around the world will hold dollars and treasuries as usually their primary asset. And that system kind of reached its peak in the early 2000s. And so I think we are starting to see a reversion to the mean where gold is becoming, a kind of regaining its kind of centrality among at least some countries' reserves. Um, and other things too, like, just basically loans to other countries that are kind of indirectly tied to hard assets, like loans to make infrastructure or commodity deposits or refining stuff. Sometimes that comes with a caveat that if those loans are defaulted on, then the rights of those assets get transferred to the lender. And so I think we're seeing a little bit more kind of hard asset commodity gold preference. The challenge, of course, is one, those types of things are less liquid. They can't be used for fast payments. And then also, the advantage of self-custody gold is that a country actually holds it, whereas a problem with those types of lending environments is if they're defaulted on, how do you enforce your property claims
Right.
in another country?
Okay. And it would be in China's best interest to continue pushing that trend forward. I mean, we touched on how many countries have been qualified as a bad actor from the perspective of the United States, therefore making them potentially eligible for sanctions, compromising their US dollar reserves. Well, obviously that's a big incentive for China, who, as you mentioned, is now the world's biggest customer, right? They've got a lot of influence in that regard. and maybe Russia as well as the world's largest commodity exporter. And you could say between these two powers, right, there's a lot of reasons they would want to inspire comparable nations to trend towards reserves outside of the US dollar. So therefore, we could probably expect this de-dollarization trend, if you want to call it that yet, to continue.
Yeah, I think so. And I mean, I think for a long time, the dollar is still going to be the largest currency in reserve baskets, or at least, on an international scale. But I think we're basically going to increasingly see a more multipolar world, which I think also reflects the fact that global GDP has become more multipolar. So, for example, when Bretton Woods was started, for example, the United States was, the last man standing after World War II. They were over 40% of global GDP. They had the industrial base, they had the gold. Whereas as you've seen developed markets recover, and as we've seen the rise of China and India and other countries back to some meaningful percentage of global GDP, the United States share of global GDP has gone down back to a somewhat more normal baseline. And when you look at Ray Dalio, I don't always agree with him, but he quantifies things well, and he had his whole changing world order um, kind of framework. And I think the most useful data set from that is he maps global empires on a number of metrics. So education, military, economy, reserve currency status, things like that. And what you generally see is that some of those metrics are leading indicators. So education, for example, is one of the first things to rise and then starts falling before other things. Whereas things like economy and military are kind of like coincident with the peak of that empire. And reserve currency is actually one of the most lagging things. So it doesn't actually start to really build momentum until the empire is kind of already really big. And then even as the empire is kind of past its prime in terms of, say, share of global power, the reserve currency takes a number of decades and it still is really hard to dislodge because it has all that existing network effect and momentum. And so the United States, in many ways, is kind of in that environment where, among many metrics, we've already kind of are past our prime, but our dollar system is still kind of near its prime. I think it's this lagging thing. And whereas like China, many metrics has become very large, while its reserve currency status is still very tiny. And so I think over time we're going to see more of a reserve diversification, payment channel diversification, and there's no world where China becomes what the U.S. was, say over the past 50 years. Like it's not going to be a world where the entire international scene is like, all kind of holding Chinese reserves. Because one, China's not big enough, the demographics are not good, the capital controls are not good. But from
Yes.
China's perspective, their main goal is to basically become as self-sovereign as possible. So they want to be less reliant on dollars as possible. They want to have as many connections with other countries with which they can pay in yuan, and have these kind of, their own payment terms. And the reason they are able to do that is because they're the largest trading partner with the majority of countries, both many cases in terms of imports, so commodities especially, but then especially in terms of outputs, so selling electronics, software, infrastructure, all sorts of things like that to other countries.
Okay. Okay. I love that. Thank you for that. That was I'm learning a lot today, Lyn. This is good. Okay, I want to use this as a segue then to jump into a couple subjects. I want to talk about perspective forecasts on gold, Bitcoin. Love to touch on energy if you'd be so inclined. Let's start with gold because we've just been covering that as a reserve asset recently. So given the last 15 minutes of our discussion, I may speculate that over the next decade, you've got a bullish sentiment towards gold. Is that correct?
Yes. So, I think the next 3 to 6 months, I don't really have an opinion on because if you get a sharp liquidity problem like we discussed in the first half of this interview, it's often not great for gold while you have negative liquidity. Um, but if you were to get either the Treasury or the Fed to kind of blink and have to start kind of reliquifying markets, that would be a probably pretty attractive environment for gold. And so, I eventually think gold will kind of break out of this, like, kind of top that it's been kind of bouncing along on. I think will kind of break out into the multiple well into the 2000s. I just don't really have a firm view on the timeline, and I think that it's largely driven by central bank reserve diversification, and the fact that it's still underallocated. I mean, if institutions even want a few percent of normal portfolios in gold, that would be a pretty big price driver. So I think it's in a pretty good shape globally. And then as far as energy is concerned, it's been a little bit surprising with the past 6 months how deep how kind of how far it came down. But I think the long-term story is still great. Basically, there's really not much marginal supply ready to come online. Kind of U.S. shale is, while it's not going to collapse anytime soon, it's that rate of change we've seen over the past decade is kind of behind us. There's not a lot of new marginal supply possible out of OPEC plus. And so I think we're in this more kind of steady state supply environment where you can get some new supply online, but at pretty significant cost. And that often with a lag. I mean, there's plenty of deep sea drilling they can do. There's plenty of these big projects, but these are often 5, 7 year plus projects. And so they're only going to do that when they have a very firm view that they're going to make their money back. And so I think the long-term story for energy is very good. And then I think importantly, even if energy chops along for a while, I think some of these producers are in good shape for it. They're profitable at current levels. Even if oil goes down $5 or $10, they can still kind of maintain their dividends, maintain their kind of core profitability. Their balance sheets are in pretty good shape in aggregate. Their valuations are not high. And so I think that there's still probably a 5 to 10 year opportunity in a lot of these energy names. I also think that energy transport is pretty attractive. Some of the MLPs, for example, a lot of them were washed out in like 2015. They were like washed out again in 2020. But now I think they have a really good foundation. Many of them are self-financing, so they're not reliant on issuing equity like they used to be. And I think they're decent income plays that are, in many cases, kind of resilient to the price of energy.
Okay. All right. And then jumping into any other commodities that you're looking at, because I read your letter, I know you've got decent exposure to the commodity sector. Where in that food chain do you like to focus, and where do you look for opportunity given, our last discussion, your prediction? And just maybe for clarity, touch on your time horizon. I think it's the most important thing, and it's often overlooked. We talk about where we might be allocating cash, what looks hot, what looks overpriced, et cetera. But a viewer might be thinking this through with the mindset of a trader, and it's completely irrelevant information, right? And so I really appreciate how when we touched on gold, you're like, I don't know what's going to happen this quarter, but frankly, it doesn't matter because here's my 5, 10 year outlook. Love to look at the commodity sector as well. And you can build energy into that because of how many conversations we have on the channel right now that focus on potential demand destruction over the next couple of years and how that may impact demand.
Yeah. To the extent that we have a recession or liquidity crisis, that can be negative for demand. When you look back at historical recessions, total energy consumption globally rarely goes down. It went down for a 3 year period in the early 1980s. That's when basically Volcker went on his like super hawkish kind of warpath, and especially Latin America got crushed. All their dollar-denominated debt got crushed. They basically had a lost decade for like oil consumption, and we're kind of like a depressionary environment for like a decade. So we kind of like in some ways killed like Latin America to kind of like get energy demand down so that more of it could go to the United States and elsewhere. It's kind of a ruthless game. So there are periods like that. The other year was 2009. If you have a global financial crisis event of that scale, we had a very marginal reduction in global energy usage, and then also 2020, of course, because of all the lockdowns. So really, in the past 40 plus years, we've had 5 years where there was a marginal reduction in total energy consumption. And except for 2020, those were not very big either. And so while it can certainly affect pricing on the margins, it's not as though you see big collapses. And so the big price collapses come from a combination of, kind of flat to down demand when you already brought a lot of new supply online,
Yeah.
right? Whereas in this current environment, we're still supply tight. And so while I do think that recessions and demand destruction can, it can push you down somewhat. It can make it stagnant somewhat. I don't think you're say you're going to crash and then stay lower for 5 years, right? That's like a different type of part of the cycle. So that's how I'd frame that. As far as other commodities I like copper and uranium. Um, uranium. I mean, many of others that cover the story. Basically, it's nuclear is one of the best energy sources. And when you look at just kind of long-term production and consumption, I think that's a very bullish story. Copper is, if you look at the gold to copper ratio, or I should say the copper to gold ratio, it's very correlated with PMI, so Purchasing Managers Index, which is like measuring the acceleration and deceleration of an economy. And these are roughly 3-year cycles. So you'll see like, maybe a year and a half of like gold doing better than copper, another year and a half of copper doing better than gold. And that is very correlated with PMI. And so over the past 18 months, we've been in this declining PMI environment. Generally, gold's been a better place to be than copper. Um, Again, the next 3 to 6 months, whether or not we have a liquidity crisis, whether or not we have a recession. So I'm not like aggressively buying copper right now. But when you do start to see a firm kind of like, you know, PMI going back up, copper to gold going back up, I would once again become quite bullish on copper because the long-term story is very constructive. That it takes a very long time to bring in a large new copper mine. There's plenty of demand. I mean, even just the existing demand, like India, the amount of copper that India is going to need over the next 10 years, even as China probably flatlines in its copper demand. Indonesia, Nigeria, a lot of these kind of fast growing countries with better demographics are still going to be large copper consumers. And then when you add any degree of electrification, right? I think in general, the electrification theme is probably overdone in terms of hype and in terms of expectations. But to the extent that it does continue to happen, that's a copper intensive um, set of things. And then lastly, I mean, in many ways, Bitcoin's a commodity. It's like a kind of an alternative monetary commodity. And the way I would frame that is it's basically the world's most decentralized and immutable database. So if you have this kind of like distributed cloud database that nobody can control, it's kind of nation state resistant, you can basically access this ledger anywhere in the world with an internet connection. And so what that allows you to do, for example, is, if you want portable money, right? Let's say you're in Lebanon and currency blew up, you can hold gold, which works, but let's say you want to bring a lot of value globally, right? And maybe those countries will let you bring a lot of value out, maybe they won't. But for example, you can't bring a lot of gold or cash through an airport. Different countries will have restrictions on how much you can maybe just export your investments and just pull like, 6, 7 figures of value from that country to another country if you were to move, right? There's all sorts of frictions there. One thing that Bitcoin does is, by memorizing 12 words or having 12 words written down or having a little drive, you can bring an unlimited amount of value globally. And you can make global permissionless payments, that settle in seconds or minutes, depending on exactly, if you're using, say, a higher layer or the base layer. And so I think having some percentage of net worth in Bitcoin is attractive. I think the network's going to likely continue to strengthen over the next decade. And I think that it's still under allocated to in large part because it's still poorly understood. So while, I don't think people should put their entire net worth in it, I think it's a very useful asset to understand how it works and then, probably to have some amount of value in it because that's basically the most portable kind of self-sovereign money you can have. Whereas, say, gold is like the most indestructible money, but it's also kind of stuck in whatever country you own it in, especially in large amounts or without relying on, centralized third parties.
Okay. Again, I just want to restate, I really appreciate how you focus on time horizon, and your final comment on Bitcoin there was that you expect the network to continue to grow over the next decade. And I completely agree with that. Part of my thesis on Bitcoin, to be honest, and it's a bet on demographics. It's a bet on the next generation and how they will think about money and currency and transactions, right? And I think that's very bullish for digital currencies. Okay. Are you reading anything interesting right now? Any book recommendations, Lyn, that you want to share with myself or my audience? I'd love anything if you've got anything front and center, top of mind.
A new book just dropped called Principles of Economics by Saifuddin Ammous. I'd recommend that one. And also, I'm actually working on a book myself. I finished it. It's currently being edited, and so hopefully by this autumn it'll be out. It's about actually the past, present, and future of money through a changing technological landscape. So people might find that interesting.
Okay, I'll be looking out for that. That's exciting news. Congratulations. Yeah.
Thank you. I appreciate that.
Yeah, what a huge undertaking, authoring a book in addition to
Yes, it's a lot of work, and even the editing and fact checking and research assistance for it is a massive undertaking. So I have very smart people helping with that.
Awesome. Okay, well that's exciting news. I love that. All right, I'll look out for that. I'll make sure we share that link with my crew, my audience when it's live. I also want to push people over to lynalden.com. There's a ton of good stuff there. You can choose your tier of membership and subscription, but even starting with your 6-week free newsletter. Once again, I love the cadence and rhythm of a 6-week newsletter because we can be so obsessed with super near-term, minute-by-minute daily headlines, which really, if you're an investor, especially a value investor, shouldn't really impact your thesis that much. I think most headlines are irrelevant by the next day. And I think a 6-week cadence is so great because it really allows me as a reader, Lyn, just by the way, to zoom out, pay attention to what you're focusing on for that 6-week period. I find it invaluable. I never miss it. And you can start with the free 6-week publication. It's a no-brainer. It's one of my absolute never miss must reads for sure. So I want to thank you for producing that every month and a half. Yeah.
I appreciate that. Thank you. I try to, my mindset there is I write it as though it's a paid newsletter, but then I put it out there for free just to see what's going on. What are the big picture things to focus on? So thank you.
Thank you for tuning in. I hope you enjoyed this conversation. Now, if you want to take the next step, I publish a weekly newsletter and it's free. There's a link to subscribe right beneath this video, and you can join me and 50,000 other investors weekly for this exclusive content where I share my key action items and takeaways from conversations just like this and plenty others. Thanks for stopping by.